And welcome to the week ahead with me, Fiona Cincotta, Senior Market Analyst here at City Index for the week, which is November the 3rd starting. So just as always, just going to take a moment for you to read through the risk warning. Okay, so without further ado, let's crack on. As always, let's just have a quick look at what's been going on in this past week. A pretty key week. I mean, it was a really busy week as far as central banks were concerned, as far as earnings were concerned, and also as far as trade talks were concerned. So, I mean, we saw US stocks rise to record highs again. They're on track for a third straight weekly gain. Before actually we reached that record high on the Wednesday before falling back, and that was after the Federal Reserve cut interest rates by 25 basis points in line with expectations. But Federal Reserve Chair Jerome Powell had a slightly more hawkish tone in the press conference, raising some questions about whether the Fed will cut rates again in December. Now, following his warnings to the market to show restraint, the markets reined in rate cut. December rate cut expectations to 70%, down from 90% prior to the meeting. Now, not only did we have the Federal Reserve, we also had the US, China. We had, I'll go through, there was so much to go through. I mean, we'll stick with what's going on sort of affecting the US first before sort of broadening out. But also Trump met with his Chinese counterpart Xi Jinping for a meeting that went well. First face-to-face meeting since 2019. Went well, but stopped short of an all-out trade deal. Trump lowered tariffs on Chinese imports to 47% from 57%, and that was in exchange for China keeping rare earths flowing, exports flowing, and also the crackdown on fentanyl trafficking. Now, we also saw a mixed week as far as earnings were concerned. So we saw that sort of pull off continue on Thursday. We saw stocks end lower on Thursday, and that was after disappointment from Meta and Microsoft. I mean, they beat on earnings and forecasts, but the market was particularly concerned about spending. However, we have seen that from the Magnificent Seven, Alphabet, Amazon, and Apple impress. Amazon's expected to open around 12% higher today, although it is worth noting that it also was underperforming its fellow peers. His Magnificent Seven peers this year, it was previously up just 4% so far this year, but that's now changing. So I mean, you know, that's basically what investors were digesting here as far as the US was concerned. And as I said, it just brought that stocks away from the record high. I mean, but if you look at the extent of the rally that we've had, that pull lower really was actually nothing. So this is the S&P 500. If we just have a look, something similar can be seen on Wall Street, also trading significantly higher. There we go, touching those record highs. Interestingly, we also saw the dollar gain across this week, obviously after we had that more hawkish than expected Federal Reserve Chair commentary, and that's helped the US dollar rise to its highest level since August, still below the 100 level. But what's really interesting was that we also had this in relation to the Japanese yen, because we had the interest rate decision from the Bank of Japan as well, who left rates unchanged in line with expectations, but they UEDA adopted a more cautious stance, so almost more dovish. So it was more of a dovish hold from the Bank of Japan. Let's not forget that expectations had been for the Bank of Japan to potentially hike rates again as soon as December. But now it's actually looking like they may look to wait for those sort of spring negotiation wage data before making a move. So that's obviously pulled on the Japanese yen significantly at the same time that we saw that strengthening in the US dollar. So US dollar, Japanese yen has seen some big moves across this week. We're up there trading at an 8-month high. And, you know, just think where we were at the beginning of October, down at the 146 level. Now we're up at the 154 level. So a massive move higher in Japanese yen, still trading within this rising channel, just testing the upper bounds of that rising channel at the moment. And the other one that we saw a big move actually was in the sterling US dollar. We did actually have the ECB rate rather than the Bank of England, but the ECB rate decision was a bit of a non-event, as was expected, with no rate cuts, with policy being in a good place, and no sense that the ECB will be doing anything anytime soon. So that really didn't give the market too much to grasp onto. But look, this is the pound US dollar. Now I'm going to bring this up because we've also got the Bank of England interest rate decision next week, but we've seen a big drop off in sterling against the value of the US dollar. So we've got, here's the economic calendar. We'll jump straight to the Bank of England, seeing that we're on central banks. Interest rate decision, that's at midday on Thursday. And so we can see that the basically the Bank of England is not expected to cut rates. It's expected to leave them at the 4% level. Recent inflation data for September came in weaker than expected, so it was unchanged at 3.8% after failing to hit the 4% forecast. Whilst the food inflation actually remains pretty high at 5%, but core inflation is also at 3.5%. Now, I mean, these levels, they're all above the Bank of England's 2% target, which combined with that uncertainty surrounding the Chancellor's November 26th budget means that policymakers will see little reason to move on rates just yet. But I think what we're seeing here in the selling off of the pound is these rising expectations that the Chancellor will be hiking taxes, and quite significantly potentially, on the 26th of November. We've seen the OBR has downwardly revised productivity. It's expected to downwardly revise productivity. We've seen government spending is extremely high. In September, it was 20.2 billion. That was 5 billion higher than the previous month, and also the second highest level on record. So with high spending, weak growth, I mean, it's, you know, there is some growth. It has been a little bit stronger than expected. I think 0.3% is what we saw, but that's not really significant at all in order to be able to drive sort of increased tax receipts for the Chancellor. So expectations, I mean, someone reported yesterday that maybe we'll see a 2p tax hike on income tax. But whatever it is, those measures slow the economy. So if the economy gets slowed, you know, the jobs market is already showing some signs of weakness, and that means that the Bank of England will likely be forced to cut interest rates potentially more aggressively next year. And that is why we're seeing this drop down in the pound, you know, real concerns over the physical outlook, breaking below a pretty key support here, the 131.50. That was the low that we saw in August. It was also the low that we saw in May. Now, obviously, this is being combined here with the high, that, you know, that move higher that we're seeing in the US dollar. But it's not just it's not just the against the US dollar. The pound is actually, I'll just bring it up very, very quickly because we don't have to focus on this this is the euro US dollar. If we just span out a little bit here, look, we can see that we're trading at the highest level since 2023, since spring 2023. So, I mean, that means that this weakness that we're seeing in the pound, we are seeing it in the pound crosses as well. So not just sterling US dollar, because of that US dollar strength. So, I mean, as far as what this chart might be telling us, we're actually oversold here. So, you know, we may see a move, but I mean, that 131.50 level, that's pretty key. I mean, the market will want, or buyers would need to see a close above that level to have any sense of this sell-off stabilizing. A close below that level potentially could open the door to a much deeper decline towards the 130 round lumber key psychological level, and below there the 127 level. So that's what's to be watching out for. What all this means for the FTSE. FTSE has had a phenomenal run higher, look, trading at record highs, which is really interesting because obviously, as we've always talked about, FTSE does lack those tech names. But, you know, we've seen this drive higher on financials. We've seen this drive higher on miners, particularly with optimism surrounding the US-China easing trade tensions, and that's, you know, helped the market rally up to this level here, which was a high of just 9,800 basically. So, and that's also been helped by the weakening pound just over the last week. The FTSE 100 is mainly made up of multinationals, about 80% of it's multinationals. So when we get a weaker pound, that's beneficial for the exchange rate of these companies, so that helps to boost the FTSE as well. So levels to be watching out here. We are a little bit overbought, so potentially, you know, if we have a look at other overbought levels, we have seen a little bit of a pullback. Pullbacks are considered to be buying opportunities. The max level on the downside, 95.80, that's the high that we saw just at the beginning of October, on the 9th of October. And then if we get a break below there, then you'd be looking at around the 93.50 level, which was the high in August, again in September. And we offered some support here in October as well. Buyers, on the other hand, with the next leg higher, will look to rise above the 9,800. I mean, on the upside, logical next levels will be the round numbers, so 9,900 and obviously that 10,000 level. So that is the Bank of England. We do also have the RBA rate decision. So, I mean, this has been a really busy couple of weeks as far as rate decisions, because we also had the Bank of Canada last week as well. But let's just have a quick talk about what we're expecting from the RBA. So the RBA will announce its rate decision on November the 4th, and this is when policymakers will decide whether to cut interest rates again from their current levels of 3.6%. Now, some economists had previously expected one more rate cut this year, but the fact that we've seen this hotter than expected inflation print will likely keep the RBA cautious. So the latest Australian inflation showed that inflation rose 1.3% on the quarter in September and 3.2% annually. Now that was up from the 2.7% in June, and marked the first quarterly increase since December 2022. Now, given that hotter than expected inflation data, the RBA will likely keep interest rates on hold, with the next rate cut not necessarily expected until February next year. Now, what we're just looking at here is the Aussie dollar, US dollar. Now, we can see it has been rising. It trades above this rising trend line. We rose to this peak here, 2025 peak of 67, but we have seen a series of lower highs since then. Recently, we've just retested that 66 level, failed, and we're now testing the 100 SMA at 65.40. So if we get any more strengthening of the US dollar, next week, which we'll come to shortly, then we could actually see that level broken down. Or also if we see a more hawkish sounding RBA, then that could see the level taken out at 66, which would then create a higher high towards the 67 level. So that's the RBA. As far as US data is concerned, there hasn't been obviously much coming out because of the ongoing US government shutdown. We did see that inflation data last week. The inflation data last week showed that the US inflation came in below. It was a little bit below expectations. So I mean, just let's bring up that DXY. It came in at 3%, and so that was slightly below the 3. I think it was 3.2 that was expected. That was expected. So the data this week we're going to be looking at. I mean, as I said, we've got this ongoing data that's between the the government shutdown. The ongoing government shutdown, which means that there hasn't been much data. However, we've still been able just to get enough to be able to keep up with what's going on as far as the health of the US economy is concerned. I mean, it hasn't been too challenging in the sense that we've got the ADP private payrolls coming this week, and obviously we have that CPI data that I was just talking about. The ADP payroll for September showed 32,000 jobs were lost, marking a second straight month of negative prints. In fact, over the last 4 months, there's only been one positive month in July, which was when we saw 104,000 jobs added. Still, I mean, we are seeing this jobs weakening from the first 5 months of the year, which, you know, supported the reason why the Fed was cutting interest rate. So because of what we'll be watching out here, I mean, this is the dollar here. I mean, I think, you know, if we're getting this ADP payroll, will be watched very closely. It could provide, because you know, there is such a lack of data, that means that the market will be clinging to the data that does come through more tightly. If we see an ongoing weakening in that ADP payroll, that will obviously then support the view that the Fed will cut rates again in December. And that could pull the US dollar lower. I think as far as levels to be watching just on the US dollar index is that 98 here, which is the 100 SMA on the downside. Obviously, if we get some recovery in the ADP payroll and a sense that private payrolls are improving, then look out for the 100 level on the upside. The other one that I think we just need to talk about whilst we're talking about the Fed and the US is gold. Gold fell sharply from that record high that we saw of 43.80 back in sort of mid-October, and it's fallen sharply. Now, we saw that fall away on the result of several things, of those easing China-US tensions, and on the strengthening dollar, which has pulled the precious metal lower. However, it did fall below 4,000 briefly, didn't really fall below that low that we were looking there for at the 39.44 level. So we're back above 4,000. And so, you know, if we do get a sense, we get that weaker than expected US jobs data next week, then that could sort of add to expectations, as I said, of Fed rate cuts, which could be beneficial for the gold price. We've also got other data from the US, but not a huge amount, so let's not get too excited. So there's the ISM services PMI, which is also due on Wednesday. Now, what we'll be looking there is for the prices paid, because we're not getting the inflation data in that we're after. We'll get some good clues there as far as jobs data is concerned, so the employment component, and also the prices paid. And the same again for the manufacturing which was just in contraction still in October after a brief recovery. Services looking a little bit on the weaker side. So, you know, if we get weak ISM figures in as well as weaker ADP data, that's just going to support these views of Fed rate cuts, which could also add to boosting market sentiment. We could see that sell-off from more hawkish sounding Powell actually reverse pretty quickly if the data starts showing that the US economy is, sorry, just bear with me, is starting to cool. So this is the NASDAQ that we're looking at here. It's risen out of that rising channel that it was trading in. We're sort of struggling and consolidating is probably the better word than struggling. We don't struggle at record highs, but there is a sense that it's just running out of steam, needing its fresh catalyst in order to be able to get that sort of 26,500, 27,000 level into focus. So that's what we're going to be looking for on the upside and the downside. So if we get some sense that the Fed is going to be cutting rates again because of the weaker data, that's going to be lifting towards that 26,500. And on the downside, so that's and then the next thing to be looking at is the OPEC meeting, which is this weekend. So this weekend we have the OPEC Plus meeting. Basically, expectations are for OPEC to announce further production output increase this weekend by 137,000 barrels. This was reported this week, and we can see first, if we have a look at the price action that we've seen, you know, we saw the fall in oil down to this low here, and that was down to 56, and that was on concerns over supply, increased supply outlooks. We also had those Chinese sort of, you know, US jitters, but then we had the news of the US applying sanctions to Rosneft and Look Oil, and then the price has actually come off, giving back some of those gains as the reports of as attention turned to OPEC Plus this weekend. Now, if they do actually, that move, I think it has been priced in now. We have seen that sort of move priced in, and that's what we've seen, this drop down to the 60 level. If we see a larger than expected increase in oil output, then that could potentially pull the price below that 60 level as we come into next week, which opens the door again to the 56 level. And then finally, the last thing to be looking at, which I don't think it's just coming up on this, because we filtered this for just the high impacting, but if we just have a look, I think we've got PMI data coming through next week. So let's just see if this brings it up for us. It brings up a whole load of stuff, doesn't it? Here we go. So we have the PMI data. This is the final PMI revisions. We've also got the Bank of Japan policy minutes, but these will be the final policy revisions, and they are due on the, I think they're due on the Friday, but let me double check. Lots of Fed speakers. Maybe they are due, there we go. They're due on the Thursday, it would appear. So there we go, sorry, the Wednesday. So this is the second readings. So it doesn't tend to be as market moving as the initial initial data, but it gives us an opportunity to look at Euro US dollar. So this is the Euro US dollar. We're finding it really testing that support there at the 115.50 level. We had the ECB meeting, as I mentioned, this week. No great surprises whatsoever. But the upside is definitely being capped by the 100 SMA there, and we're still below that 117 level. You know, hasn't managed to push above that 117 level now for quite some time, since the beginning of the month, and that's owing to that US dollar strength we're seeing. So I think, you know, given that perhaps there aren't as many factors driving the euro right now, given that policy is in a good place and the ECB isn't giving us too much else, this does seem to be moving more owing to US dollar than to necessarily euro strength. So there, you know, it's worth watching out on the US data for the USD crosses, but that's the level 115.50. If we get 115.45, 115.50, that was the high that we saw back in April. It's a level which has offered support in mid-October. A break below that level immediately exposes 115, and then below that we get the 114 level, which was the low that we saw back in July. So that could be the next side on the upside. Upside, we do need a break, a close above the 115.60. That's the 116.60, the 100 SMA, in order to be able to push higher towards that 118.30, which was the July high. So I hope you've liked everything that we've discussed today, and I look forward to seeing you again next week.